Happy Thursday. Welcome to Bear Market Brews, brought to you by Hixon, Zuercher, Capital Management. I am Tony Hixon. It's 4 o'clock. The markets are closed, and the virtual happy hour is about to begin. As always, I am joined by my venerable and esteemed colleagues, Adam Zuercher and Austin Wilson. What's up, guys?
Hey.
We invite you to sit back, relax, crack open a bottle of your favorite brew or beverage as we break down all things COVID-19, show you how markets are responding, and share our latest views. At the end of every call, we love your questions. There will be a Q&A at the end of every webinar that we have, so get ready. Here we go. All right. Adam, Austin, good to see you guys today. An update in the market. Did you guys have a good day?
It was a good day.
Very good day. Good week.
A good week. The best week since what?
1974. Best week since 1974 for the S&P 500.
Wow. So, guys, I got a problem. My hair is growing a bit too long. Barbershops are closed. My kids are pointing at it, saying there's a little bit more gray than we're used to, Dad. What's going on? I'm used to just shaving it off, but it's growing out. So I thought about an idea I have. Get you guys' reaction. I thought about not cutting my hair until the bear market's over.
Okay.
Wow.
What do you think?
Tony, you're on record, and I like it.
Is that crazy?
I like it.
Do it.
By the time it's all said and done.
That's right.
It's all good.
So it's going to be interesting to see, does Tony get a haircut before Austin creates the bear market blues?
Ooh, it's a competition. Let's do it.
As a reminder, Austin has guaranteed that he will sing live the Bear Market Blues if we get 1,000 subscribers and attendees to the Bear Market Brewery. All right.
That's right.
Let's go around the circle, introduce ourselves, and what are you drinking? Austin, start with you.
Yeah, I am Austin Wilson, research analyst at Hixon, Zuercher, Capital Management, and I am drinking Findlay Brewing Company's Brilliant Blonde in their 25-ounce crowlers that you can now get from Findlay Brewing Company. Picked a couple of those up over the weekend, so I'm excited. It's good beer. It's good stuff.
Cool. Good deal. Circle around to Adam. How are you? Who are you? And what are you drinking?
Doing good. I am a co-founder of Hixon, Zuercher Capital Management, Adam Zuercher, and work closely with Tony and Austin here on the investment team. We've been meeting ongoing every day through this bear market. And so this is my third bear market of my career. We actually started our firm during a bear market back in 2002. So bear markets are nothing new to us. We've had some experience with them, but doesn't mean we always enjoy them. Certainly we do like bull markets better. But we do want you to know that it's okay to have a good time during bear markets as well. So that's why we want to lighten the mood a little bit and have bear market brews. So what I am drinking, also a crowler from Findlay Brewing Company, my favorite local brewer.
That's right.
By the way, National Beer Day 2 days ago, April 7th.
Boom.
Also Tony's birthday.
Hey,
happy birthday, Tony.
Oh, that's a good one right there.
So they had a special 3 crowlers for $20. So I picked up a Lunar Lander, which is a New England IPA, and I'm drinking it. I had to support them and buy my own Findlay Brewing pint glass.
That's awesome.
Awesome. Looks good. Well, as I stated, my name is Tony Hixon. I picked up a Leisure Lagoon, a hazy pale IPA. It says you get the best of the East Coast and a little bit of West Coast all in one can. So happy about that. Should be fun. I am a partner, client-facing advisor here at the firm. But what we really would like to know is, what are you drinking? So in your webinar chat box, go to the bottom of your screen. You'll see a chat box. When you type it in there, make sure that you hit the drop down and say all participants, all attendees. We would like to know what it is that you are drinking as well. So while you go ahead and chat, put your what you're drinking into the chat box, I will also remind you that the Q&A box is different. Two separate things. The chat is the chat amongst the brewery. It's fun. The Q&A box is just for the hosts. So once I receive a Q&A, a question, I will make sure that we either answer it live or shortly after the call. All right, we got ourselves some chats coming in. Bud Light. Nothing wrong with that, Joe. No problem. Great Lakes IPA. A Hissy Fit. My daughter had one of those earlier today.
Dallas, we've got
not
Eric
the beer.
Dallas on the call.
Yeah.
All right, good.
Thanks
stuff.
for coming, Eric.
Good stuff on the chat box. Keep the things coming. We got some vitamin water. You can't complain about vitamin water.
Stay healthy.
Stay healthy, my friends. Good stuff. All right. So first, I think we'd start off with kind of an update. I guess, Adam, if you're willing to share your screen.
Yes, sir.
And first thing we want to do is make our attorneys happy. We are happy here in the brewery, but it wouldn't be happy for them if we did not share some disclosures. So there's your disclosures. We'll leave those up for another 5 seconds before we move into Austin with his report on COVID-19 cases. All right, Austin, what are we seeing so far in the data?
Yeah, so we've definitely continued to see some increase in COVID-19 cases, specifically here in the U.S. Our cases are now over 430,000 cases. So things have escalated quickly here in the States. But one new way that we are really trying to track this as far as a change percentage is, if we look at the next slide, we can see that we see the case count change day over day. And what we want to see is that being reduced over time. So in blue, we see the U.S. COVID-19 case count day over day change. In orange, we see the 5-day moving average of that. And ideally, we want to see both of those moving down and to the right over time. And that is exactly what we are seeing. Cases are increasing at a lower percentage lately than they were even 1 or 2 weeks ago. And that leaves us feeling a lot better about the situation that we're seeing here in the States. So that is a good thing we're seeing. If we look at deaths on the next slide in the U.S. specifically, we're seeing a similar trend. And we're calculating that the same way. We're seeing death percent change day over day declining for the last week or so. So those last few days specifically have really gotten pretty low. And that gray bar, or the gray line we see there, is the 5-day moving average on death change day over day. So continuing to see that move down and to the right is what we are looking for, and we're seeing that. So it's a very good thing for us.
Cool. Good deal. Quick housekeeping note. I would say that we're having some issues with some technology on the back end of our Facebook live feed, so I apologize for that, but we will continue. The next slide here, we're talking about Fauci and what has he said recently about the cases.
So well, just recently, yesterday, Dr. Fauci, who is the head doctor of this whole epidemic, he has come out and reduced his projection for the total number of cases in the U.S. And actually, he's looking at fatalities coming in around 60,000, which is less than half of the 200,000 that they projected just not too long ago. So as we mentioned at the top of the hour, the stock market has had the best week since 1974, and this is certainly what's driving it. Is there's a lot of optimism right now about the fact that cases are coming in lower than expected. As a country, we've done a great job of flattening the curve, and we've talked on these webinars about the fact that we're in Ohio. And our governor has kind of been on the leading edge of all that as we've shut down things for weeks now. And we're seeing good numbers. So that's a positive. We can all be thankful for that. So let's not forget what's really going on here. Sometimes it's really hard to remember the fact that there are people whose lives are being changed and they have loved ones that they've lost. And we don't take that, we're certainly not undermining that, but we definitely are thankful that we are coming in under those projections. And so now there's big hopes that we will be able to reopen the economy sooner than sooner than later. And so if we reopen the economy, that's a good thing, of course. It means that the recession potentially will not be as bad as we've been talking about the past few weeks, and we can get people back to work, and we can get back to what we thought was a normal life. And so the stock market has been moving higher on those optimistic things that have been reported over the past day or two. So we'll see where we come in, but so far the numbers are looking pretty solid.
Yeah, the numbers are looking solid in the U.S. And if we look globally, so on the next slide, we see that global cases now, they have exceeded 1.5 million. But overall, that rate of growth over a longer term is continuing to do similar to what it is in the U.S., and it's helping us out. And as far as flattening the curve. So when we talk about flattening the curve, we've got a nice chart here where we compare some of the hot spots of COVID-19 around the world. And we see in the red, the United States curve, we see that flattening at the top. We see that tapering off and becoming more or less straight up and down. So that's a very, very good thing for us. And we're starting to look like some of these other economies that have really clamped down on the growth of the virus. And we continue to really want that curve to look a lot like South Korea is the goal there. They did a really good job of clamping it down real quick. And as we see this social distancing continue to take impact on the virus spread, we're continuing to see that curve flatten. So we anticipate that will continue here going forward. One number that came out and continues to come out every Thursday, we have these calls on Thursdays, but it's also the same day that the initial jobless claims numbers come out every week. Jobless claims this morning came in at 6.6 million new. So that's initial jobless claims week over week. So 6.6 million people in America filed for unemployment insurance for the first time. And,
how many, Austin, how many did we have last week?
6.6 million. So very, very similar numbers. Yes, similar numbers week over week.
And then if we go back to 2 weeks ago, it was 3.3.
2 weeks ago was 3 million. So yeah, so we are 10
that was
times.
a record number, right? So
yeah, that was a record number as well. So we are, as these last 2 weeks have come in at 6.6 million, that 6.6 million is actually about 10 times the pre-COVID-19, records for initial jobless claims in a week. That is a big number. And as we can see here, the stock market typically does not perform so well when initial jobless claims go up. And we're seeing that now as we've had this bear market, where, kind of one of the reasons we're having this call, the stock market has gone down and jobless claims have gone up. So that's something we're definitely watching. We now have 16 million workers that have filed for unemployment in the last 3 weeks, and that's about 5% of the population. I feel like that number is probably a little low because a lot of people probably have been called, quote unquote, back to work. Because of the CARES Act has so many provisions for employers to have incentive to continue to keep their employees on the payroll and to pay them, that maybe people are not filing jobless claims as they would in a normal economy.
Right. So that's a great point. I mean, if we didn't have the stimulus that we had with the CARES Act, which we talked a little bit about last week, and you and Josh did a podcast about this, but with the CARES Act, there was a $350 billion stimulus program for small businesses where they are basically loaning small businesses that money to essentially keep people on, and they call it the payroll protection program.
Right.
And basically you can look at your average payroll for the prior year and you can get a loan equal to 2.5 times your average monthly payroll. And as long as you use that money to pay for payroll over the next 8 weeks and your job count doesn't change over the next 8 weeks, then the government's going to forgive that money. So there's a lot of incentive here for small businesses to keep their employees and not lay them off. And so had we not had that program, we might see a much higher number on jobless claims. So although 6 million is a lot of people that filed for unemployment, it's our belief that it would be a lot higher without that program.
Very true. And so as we as an investment team, we meet every morning. We were on a Zoom call when this jobs report came out, and we thought, oh my goodness, the Dow and the markets are probably going to not enjoy that number. And we thought for sure it was going to be down. And we thought the same thing last week too. But nonetheless, the market has actually closed 4 o'clock and it closed up. So Austin, Adam, what was it that the markets were reacting to that was so positive that made them close up?
Yeah, for sure. It was, it kind of counterintuitive, and we were kind of bracing ourselves for what we anticipated to be a little bit of a rough day. But around the same time, the jobs number came in, which was worse than estimates. So it was about the same as last week, but it was worse than estimates by about 1 million. So not good at all. The Federal Reserve came out and said, "Hey, we're going to start doing a little bit more and try and ease the lending." For small businesses and for banks to be able to assist those small businesses. And that really offset, and then some, the bad news that we saw in the job market. And that helped the markets finish higher over the day. So yeah, we were kind of bracing for a rougher day, but we got good news from the Federal Reserve. And that's kind of been an overall theme of this cycle. So this cycle is very unusual, and it's hard to really plan what's going to happen next because when you have all these bad things happening, bad news in case numbers and deaths, bad news in, jobs numbers, but then you have a government that's really coming to bat for the country. Indeed. So I think that that's a really unique situation that America is putting itself in, is that we've got a Federal Reserve and a federal government that are both just doing whatever it takes to not let the economy fail in any way, shape, or form.
Indeed.
And they're taking action much faster than they ever have in any other crisis. So many people compare what's happening today to 2008 because, we all have recency bias. Many of us on this call probably remember what 2008, 2009 was like. And it was painful, to be frank with you. And it seemed to last longer than it did. I mean, I remember there were 6 months in a row where the market was down. And none of our clients enjoyed getting their account statements after the end of each month and seeing that they had lost money that month, temporarily, of course. But, if you look at how quickly the Fed is reacting to this, as well as the federal government, and how quickly they're getting stimulus out to help people, this is unprecedented. And I think one thing we're learning is this time is a little different because you have the Fed and the government there to backstop the economy and make sure they're basically willing to do anything to make sure that we get through this without too much damage.
Indeed. And that's oftentimes credited to our president, Mr. Trump, whose approval ratings are actually quite high in this crisis. But this week we had some news on the Democratic presidential front, campaign front. Who wants to chat about what happened there in the Democratic side?
Well, we learned yesterday that Bernie Sanders ended his campaign or his run for president. And so that basically leaves Joe Biden as the Democratic Party's presumptive nominee for the 2020 election. And when Mr. Sanders dropped out of the race, he did mention that the coronavirus was a critical factor in his decision to leave the race. So, we're looking at this and, it was kind of heading that direction anyhow. But what we see now is clearly it's a Trump versus Biden race. And we believe that removes a little bit of risk from the markets because we felt like, well, if Bernie Sanders, if he would win the election, the market would probably, there's some risk there that the market would have a negative reaction because of some of his policy positions, mostly around healthcare and other policies. What we know about Trump, so the benefit of looking at Trump is we've had 4 years with Trump and we see that the market has responded quite well to a Trump presidency. So the assumption is if Trump wins, the market will not have a negative reaction. And so now what we're showing you on the slide here is there's this cool website where you can go and you can get the current betting odds. So how people are actually putting money on bets for the election. So it's electionbettingodds.com. And this was as of this morning. Of course, Biden is all the bets are going towards him to get the nomination for the Democratic candidate. But for the next president, we do see Trump at about 50% of the bets and 43% Biden. Now, a lot can change, and I think, we'll certainly see how does Trump manage the coronavirus crisis that we're in, and what happens between now and November is going to definitely play a major role. But one thing that the markets do like is certainty. And so we now have certainty. It's a Trump versus Biden presidency. And if Biden would win, our view there is that we don't really expect that to be a shock to the markets, meaning there's nothing that would be, a major negative for the markets if he wins. You have to remember that politics and investing do not mix. If you look at history, we've had up markets with both Republicans and Democrats in the White House. And so Biden's a little closer to the middle than Mr. Sanders was. And so that's probably better for the market. So we look at this as a bullish update to the news events of the week.
Makes sense. Yeah, good. So as we know, GDP, or gross domestic product, is largely driven by consumer spending. Well, the consumer has gotten hit because a lot of them are unemployed, not making money to spend it into the economy. So let's take a quick check in on consumer confidence gauge. Austin, what are you seeing in that metric?
Yeah, really great point, Tony. Consumers really contribute about 70% to our GDP as a country, which is huge and bigger than a lot of the other countries in the world. So we're largely driven on consumer. So the confidence of the consumer is actually paramount for our stock market performance. And what we can see here is in the white, we see consumer confidence over time. In the blue, we see the S&P 500 over time. And we're really looking through the last two recessions that we've experienced, looking back to about 2000 there. So we can see that prior to the dot-com bubble, so two recessions ago, prior to that, we actually, we were ticking along in the 100, 110 range in terms of consumer confidence. So that's really, really good. Then the dot-com bubble happened. A lot of people lost their jobs, a lot of turmoil in the economy in general. So then people ho-hummed around in the 80 to 100 range for an extended period of time up until about the end of 2007. What we see at the end of 2007 is a very sharp drop, and a sharp drop notably below about 80, and really got down to below 60 in the depths of the financial crisis. So what happens is when we see big drops in consumer confidence, consumers are a lot less willing to go spend money, and that spending of money as a big component of GDP is really not propping up the economy and therefore the stock market. So what we've seen in this most recent, run up to where we're at now is that consumers had just gotten their feet back under them from about 2014 or 15 until through 2019, after coming out of the global financial crisis. But then coronavirus hit, and a lot of people lost their jobs, and their consumer confidence has extremely been shaken because of that, down to the most recent reading as of this morning of 71. So really below that 80 range, that signals a really tough place for the consumer. And that's really a leading indicator of what we think is going to lead into, a very clearly COVID-19 induced recession of some sort.
Indeed. Unfortunately, this chart is put together by the University of Michigan, I should say. And from what I understand, we may not like that, but nonetheless, we give them credit. They do a good job. All right. So consumers don't really have jobs, but no one's really driving anywhere. We all are obeying the stay-at-home order. What is happening to oil?
Yeah, oil has been all over the place recently, mostly down. It's been like a slide for most of the year. But what we've seen specifically recently is kind of a bottom being reached on oil prices. And a lot of oil-producing companies that have decided that, hey, we don't need all this extra oil we're producing that's really driving prices down further and hurting our economies. We're going to cut production. And what has given a little bit of the floor in the last week or so is discussions with specifically Russia and Saudi Arabia that they're working on agreements to cut oil production, and that should further put a little bit of a floor into the oil market. And that is a good thing for specifically our oil companies here in the States. As you know, we're located here in Findlay, Ohio. Marathon Petroleum Corporation is headquartered here. Their stock has not done well as oil has gone down, because gas prices have gone down and their margins have really come down as well. And that is something that for companies like them, as well as more diversified upstream oil companies, that's going to help them out. And, you know, while it's a lot smaller portion of the stock market than it used to be, it's going to help, you know, kind of give us a little bit of support here in the equity markets.
Indeed. All right. Adam, let's do a quick check on the markets. What's 2020 looking like from the major market indices?
Sure. Well, one second here. Sorry, we're having some technical difficulties. There we go. So what you're seeing on your screen now is year-to-date numbers for the major indexes for the U.S. So you see S&P 500 in white, we're down 13.7% year-to-date. The Dow's down 17.3%, and the NASDAQ down 9.8%. You know, when I see those numbers, I'm actually quite surprised, because if you look here, the bottom on March 23rd, looking at the S&P 500, for example, we were 35% off of the all-time high from February 19th. So as of today, it's looking like that 35% drawdown is about, you know, so far that's the low. And we've seen a nice rally here off of that low. And that brings me to my next slide. The big question is, are we living through a bear market rally? In other words, is this deja vu? I mean, is this like 2008 all over again? Or have we literally started a brand new bull market? So what you're looking at on this chart, we are comparing the current movement in the US stock market in red with what happened in 2008 when Lehman Brothers collapsed. So this chart is showing you where the market in black started on September 12, 2008, which was the last trading day before Lehman Brothers declared bankruptcy. And what you see is, it's very kind of eerie how the market is just tracking that same path after Lehman declared bankruptcy. And what happened was, you can see that we hit a bottom in October, late October, and then we had this rally. And so many people were thinking, well, this might be it. We might be out of the woods here. But what was discovered then was that there was way more pain in the financial sector. There were problems with banks, problems with consumers, and so forth. And what happened was, we had another leg down, followed by another rally in December. And then January and February of 2009 were very unpleasant months. And we hit the low in March of 2009. So the question is, you know, we just had, again, the best week since 1974. Is this just a rally within the bear market? And are we preparing to go lower? Or are we is this it? Are we gonna see a V-shaped recovery like some people have talked about? And the answer is, we don't know.
Yeah,
I wish I could tell you.
What was the difference between the Lehman collapse versus where we are today, though?
I think the biggest difference is, look, the government let Lehman Brothers fail. And what we're seeing today is, they don't want anybody to fail, right?
Right. Yeah.
And so they're sending checks to Americans. They are sending money to small businesses. And, you know, there's also, that's another, a good point, is that we talked about that last week, is the amount of money, $350 billion, they're sending to small businesses. And there's been huge demand for that. So much demand that many banks don't have the capital to lend. So that's why what the Fed did today was they stepped in to help those banks. They're loaning money to the small banks so they can lend to small businesses. Mm-hmm. And there's policy, new bills being introduced to actually increase that amount, because the demand has been so big. But I think the biggest difference is, it appears to us that today the government doesn't want anybody to fail. Yeah. And so they're going to do anything to keep things going. Plus, we're seeing, again, unprecedented speed by policymakers to, put stimulus into the economy. So I think there is a good shot because of the flattening curve and that sort of thing. There's a good shot that this is sustainable. On the other hand, I do think that there is a risk. There's a risk that, okay, we get through the coronavirus crisis and we kind of see the curve flattening, but then, beginning next week, we start to see quarterly earnings reports coming out. And so we get to see the actual impact to individual companies. And if it's worse than expected, well, maybe that's cause for the market to go another leg down. If the duration of the recession lasts longer than expected, that's another reason the market could have another leg down. But I think it's our view. Let's go back to where we were before all this started. I mean, we were very bullish at the beginning of the year. The economy was firing on all cylinders. The only thing that stopped it was a health crisis. Yeah. And if we can get the health crisis managed well, then I think I'm in agreement with Trump that once we reopen, the economy starts booming again. Now, it's going to take a little bit of time because our economy was never designed just to stop. And there are certain sectors and certain businesses that are going to take time to, ride that on-ramp back to recovery. But I think it's going to be faster than, say, a 2008, 2009 recession.
Yep. This is a bit like, Lehman was just not a really well-run business.
True.
Whereas today, this is more like a natural disaster. And so the government is coming in to repair a nation after a natural disaster has occurred. So let's move on. I'll give you a few seconds to cover some volatility. I would mention that Austin and Josh, they do a weekly podcast called The Invested Dads, and they have a whole great episode this week, episode 17, on volatility. So Adam, where are we at with the VIX index, which is a measure of volatility?
Yeah, good point, Tony. They just released that podcast today. So go to your favorite podcast listening platform and look up the Invested Dads podcast, and they talk all about volatility. Or go to their website, www.theinvesteddads.com. What you're seeing on your screen now is the VIX index, which we call the fear gauge. The higher the VIX number, the higher the fear in the market, which means people are generally selling. If you look here, we hit an all-time high on that index back on March 16th with a VIX rating of 82, basically 82 points. Today, we're at 42. So we've almost cut that in half, and we've seen a major drop down. Now, what we like to see is the VIX trading less than 60, and we want it to be below its 20-day moving average. And we're seeing both. I mean, just a week ago, we were right in here. So that's very positive news because one of the things we're looking for to get more bullish on the market in the near term is a declining VIX. And we now have a VIX rating of 42, and we want to see that 20-day moving average. We want to see it below the 20-day moving average and a declining 20-day moving average. So we're seeing very good numbers on volatility, which means things are calming down a bit.
Cool. And Adam, one thing that is kind of a good way to look at this is a couple of weeks ago, we were looking at stock market moves where the Dow was swinging 1,000, 2,000 points in a day. And those were the days where the VIX was up near the all-time highs, right? Exactly. Well, now we're in a more quote unquote normal, trading range where we had a 280 point, Dow day or whatever. That is very, very within reason,
exactly,
which is a lot better. So I think things are calming down.
Yep. Great.
Agreed.
Point.
Let's do a couple more slides. Want to check in on breadth. So breadth is what we're looking for is how many stocks are participating in the rally. So is there just a few that are starting to look good, or is there a large breadth of them that are also trading well also? So as we look at this chart, what are we seeing as far as breadth in the markets?
Yeah, that's a great point. When you see up moves in the market, you want to see a lot of stocks participating in those up moves. Yeah. One way, there's lots of ways to measure breadth, but one of my favorite ways is looking at how many stocks are trading above their 200-day moving average. And it's very few today because 200 days, that was a long time ago. Okay. And we had a big move down over the last, 30 days. And now what we're seeing is that number hit, almost all-time lows here as far as the number of stocks trading below their 200-day. Last week, we showed you a chart that showed that you really want this number to be above 15%. That's really a good indicator for when to get bullish on stocks again, is when the percentage of members in an index like the S&P 500, you want to see 15% or more trading above their 200-day. And I have good news this week. Last week, we told you it was less than 9%. This week, we're looking at over 16% of stocks are trading above their 200-day moving average.
Did I hear you just say good news?
I love
Yes.
good news.
Cheers. Cheers to good news.
Cheers.
Here.
Finally, some good news. So yes, actually this week's been kind of full of good news, but that's exactly what we've been looking for, and we've been talking about it the past 3 weeks. So obviously you see that moving in the right direction. This is a good number. We want to see that, hopefully that's sustainable.
So quickly define breadth one more time. What does that actually mean? What are we talking about when we say breadth?
Yeah, breadth. Think of when we talk about stock market indexes or averages, what percentage of those are participating in the move up or down? So if you have up days in the market, you want to see a lot of stocks participating in those up days. There's other measures, like one is how many stocks had advances today, meaning how many traded higher than they did yesterday. So there's also the advance and decliners line. And so we net the number of stocks that went up versus the number that went down. And if that line is moving up, that's a positive sign that there's breadth in the market. So think of it like this. There's 500 stocks in the S&P 500, okay? If all 500 hit or were trading above their 200-day moving average, which would be a great indicator that we're in a bull market, then we would see this at 100%, okay? Which we've never really gotten that high. You can see coming out of 08, 09, breadth or the percentage of stocks that traded above their 200-day was constantly increasing. And we've been really above 50%, meaning if you have 500 stocks in the index, more than 250 of them were trading above their long-term price, which is the 200-day moving average, throughout this bull market that we've had the past 10 years.
Makes sense. Cool. All right. One last chart before we get to the summary slide. What are the trends that we're seeing in the market? We like to look at some moving averages, specifically the 8 and 21 might have had some news today.
Yeah. So one great way to look at trends of the market. So what you're looking at here is a year-to-date price chart. In white, you see the daily moves in the market. And you can see, obviously this was February 19th. We had this down move, and now this was March 23rd, and we're moving up again. But one way to smooth out the noise of the daily price moves is to look at moving averages. So here in pink, you have an 8-day moving average, which is just taking the last 8 days and it's averaging their price. Now we use an exponential moving average, which is giving more weight to more recent days. Then you have the 21-day, you have the 50-day and the 200. The 200-day, again, is really long-term time frame. It's saying, where's the market going? What you see here is we see a gradual declining slope. But if I were to expand this chart over the past 10 years, you would definitely see an up and to the right slope. The 50-day is more of an intermediate trend. And then our short-term trend indicators are the 8 and 21-day. So when we're in a bear market like this, we pay a lot of attention to 8 and 21 because that really helps us determine when we want to get more aggressive with our buying or repositioning of the portfolio. And so what we want to see, you always want to, in a perfect world, if there is such a thing, you want to see price at the top you want to see the 8-day, 21, 50, and 200 below that. So in other words, you always want the most recent price or the shorter term moving averages to trade above the longer term. And that's exactly what we had leading up to February 19th, which was the peak of the bull market. And the next day we started, February 20th, we started to go down. And right here, this was an indicator when the price dropped big and you saw this pink line dip below the yellow, the 21, that's a sign that things are changing. And then as all these shorter term moving averages drop below the 200-day, that was a sign that we are now in a bear market. Now we're seeing the opposite. We're starting to see the trend change. And this is the first time in this Bear Market Brews series that we have good news on this chart, because as of today, we see a price that is now greater than the 8-day moving average, the pink, also greater than the 21. That was big news a few days ago, earlier this week. We crossed the 21. But also big news is, see right there where the pink crossed above the 21. When that moving average is, when the short-term moving average crosses the next one, that's a good sign. And so we're also, another key point here is this 50-day. If we can close above the 50-day, that would be a great sign. And really, ultimately, we want to break out above that 200. But what this is telling us is that the trend is reversing. Obviously, it was down here. Now it's starting to reverse.
Got it. Cool. All right. We're nearing the end. Austin, I'm going to turn it over to you. We've covered a lot of ground today. Let us go through some of the highlights and let's discover, are we bullish or are we bearish on some of the indicators that we talked about today? So go ahead, Austin.
Yeah, that sounds good. So number one, we believe that it is super bullish that the COVID-19 curves are flattening. That's something that we're looking for and keeping an eye on, but we are very bullish on that. The numbers keep coming in better than expected. Number two, we feel that we are bullish that Dr. Fauci says U.S. virus deaths may be 60,000, only 60,000, which is sad that it's still 60,000, but that is less than that. Less than half of the original projections that were just given a week or two ago. Number three, we are bullish that there is a lot of talk about reopening the economy sooner rather than later. So that's leaving us with really good feelings there. Number four, we are bullish that oil prices are rebounding and stabilizing as production is cut really around the world. So that we feel is putting some stability into the specific equities around the energy sector, and is a very good thing for us there. Number five, jobless claims came in 6.6 million versus a forecast of 5 million. It's a little bit lower than last week, but much higher than expected. We are bearish about jobless claims. The jobs market is not a really good thing that we're seeing right now. So we're bearish on that. Number six, today, the Fed announced they are adding $2.3 trillion in new loans to support the economy, really to support small business. So the Fed is going big, and they're going big quickly. So we're bullish on the Fed. Go Fed. They're doing their job. Number seven, Bernie Sanders has dropped out of the presidential race. So from a stock market standpoint, we feel this is a bullish thing because he left a lot of uncertainty out there in the equity markets, specifically when it relates to healthcare and financials specifically. So that's bullish for the market. Number eight, volatility is calming down. People are being a lot less fearful. The moves are a lot less drastic each and every day, and that's something we like to see. So we're bullish about that. Number nine, the stock market breadth. So like the percentage of stocks that are trading over the 200-day moving average, or the majority, the stocks that are participating in this rebound we're seeing is a lot higher than it had been. And that is something we are bullish on. And number 10, finally, the stock market trend is changing direction. The trend is our friend. We like it when the trend's our friend, and that short-term moving average has crossed the longer-term moving average, and we feel like we are setting ourselves up for a little bit of stability going forward. And even if the market does, go down at some point, these moving averages tend to act as some sort of resistance when you're going down. So we feel like that's a pretty encouraging sign we're seeing from the market. And a list of 10 things that we feel generally not perfect, We do not feel like things are certain. We do not feel like things are really well known, but we feel like we've gotten a lot better really over week, really over the last couple weeks. But we're not really like bulls. We're not saying put the farm up for sale and buy stocks. that sounds a little too risky at this point, but we're saying it's better than it was.
Yep. So these 10 things we happened to select for today's call. Adam, we did have a question come in specifically from a Guinness Draft Stout drinker, Jeff. He wants to know, when are we going to change the name of this webinar from Bear Market Brews to Bull Market Brews? There's 9 things we're bullish about. Are you ready to change the name?
Wow. Yeah, I would love to change the name to Bull Market Brews. Here's the thing. So, some journalists are actually claiming that we're in a bull market. And that's because if you look at the March 23rd low and you look at how much we've appreciated off of that, it's more than 20%. So the definition of a bear market is when you have a 20% drop from an all-time high, which we've had. Remember, we were down 37%. A bull market is when you basically go off of that previous high and you're 20% up. And so, 20% off of the last low. The fact is we are 20% off of the last low. So if we know that we'll never have a retest of that low, and we never, go down, we're still in a bear market. We cannot officially say that we're in a bull market until we reclaim the February 19th high. So when we get back to that all-time high level, then we can say, yes, we've been in a bull market since March 23rd. So you never know. It's always in hindsight. In other words, it's too early to call officially, but it's possible that we are in a bull market, and we're not going to change the name of our webinar or our live series here until we actually reclaim those new highs.
Indeed. All right. We've got a few more Q&As here to go. So boys, stay on the line. Boys and girls, stay on the line. It'll be great. So before we get to the Q&A, I want to give a quick shout out to the fact that we're here to help. Bottom line, if you're like many investors, this market has you unsure about your next move. That's why we're here. We have developed our firm to help investors just like you make wise decisions about your money. Head on over to hzcapital.com/start. Follow our 6-step process. We have certified financial planners. We have certified investment management analysts standing by with a passion, a desire, experience to help you make wise decisions and walk along your financial journey correctly. That's why we exist. We get out of bed every day in the morning to live out that purpose. And so we're excited and hopeful that even if you're a client on the call, that you might share that link with someone you know that might need some of our help. All right. So head on over hzcapital.com/start. All right, boys, we got a couple of questions. We answered a few along the way, but Boring Bud Light Joe wants to know, what are some hedging options for investors that we can suggest?
Good question, Joe. I think it depends what you're hedging against, and I'm gonna go out on a limb and say you're probably hedging that. What if this bull market that maybe has started? We presented, this was the most bullish we've been on these series. On these Thursday calls, if this is sustainable, and if we don't hit a new low, but what if the economy doesn't rebound as quickly as we thought? I think one hedging strategy we have seen or we have employed is at one point before a few weeks back, we had generated a little bit of cash, and it was nice to have some dry powder. We actually started, because of so many bullish signs, we put a little bit of that cash back to work today. Not all of it. And by the way, we didn't go all cash. Still pretty significantly invested for our clients. So cash is always a hedge, as a temporary hedge. The bond market, history says the bond market will cushion equity declines. And it does pretty well. But interest rates are so low, don't expect any growth on your bonds. And interest rates, every time you think they're as low as they can get, they always go lower. So bonds are a decent hedge. But, the way I would look at it, Joe, is last week we talked about positioning and repositioning your portfolio so that you're participating in the sectors that are benefiting from the current activity or the current environment. So things we talked about was reducing your exposure to financial stocks, especially bank stocks with interest rates so low, reducing your exposure to energy stocks with oil prices being so low. And we showed some charts on here's where the strength is. And really the strength is in the technology sector. And I believe that's going to continue. Looking out ahead about as far as I can see, even through the next 10 years, I think the technology sector is primed for a lot of the growth. And, my favorite business model in that sector is software companies that have software as a service where you pay a monthly subscription, you get their software. They have an unbeatable business model because if you have software that people depend on, like us, our firm, we are subscribers of Microsoft Office 365. Just because we're in a recession, we're not going to cancel our subscription to Microsoft Office 365. And so that's a durable business model right there. It's monthly recurring revenue. Another sector we like a lot right now is healthcare, and consumer sectors, staples, even affordable luxury. We've talked a lot about as an investment team is we believe there are certain things that people are going to continue to buy. So I think it's more about, the best hedging is really to think about thematically, what do you expect to do well over the next, you have to consider your time frame, of course, we're long-term investors, but where do you see the economy rewarding? And I think certain pockets of the economy will do quite well and others are going to continue to lag.
Cool.
Anyone else on the team have any other thoughts on that question?
Yeah, actually, we actually got a question from Russ about 5G. And I think that, 5G technology is really the fifth generation of wireless technology. I think that is a continuation of that theme Adam was talking about, about technology being a kind of a growth catalyst. And I think it's going to be huge. And ironically, Verizon had just announced in the midst of all of this COVID issues we're having, they had announced that they're increasing spending on 5G implementation. And that's something that we're super bullish about. We think that 5G has a lot of opportunity for terms of artificial intelligence and automation. So that's something we're watching very closely in general. So thanks for that question, Russ.
Indeed. Russ, who's coming to us with the Corona premiere. Love it.
That's right.
All right. Eric, drinking the hissy fit. He's asking a question. If the market reopens earlier than planned, and then we see the COVID-19 curves turning in the wrong direction, what are we going to do?
Yeah, Eric, that's a great question. We, as investment managing, people, we have to think of both sides. So we gave a lot of bullish things that we're seeing in the markets, but that is one of the things that keeps us kind of from thinking we're in the all clear here, because it was just today that the CDC in South Korea announced that they are having actual reinfections of people who have had COVID-19 and are getting COVID-19 again after they've already been, healed up and all sent home and everything. So that is something that's a real, it's a real worry. It's something that we need to be watching here as people who are looking at the stock market, but also as just humans in living in this COVID-19 economy. So I think that is a real risk. And I think a second round of flare-ups in terms of hotspots and cases is a real risk to the economy if we open up too soon. And I kind of hope that as a country, we take a bit more conservative approach and make sure that we are ready when we open things back up. So I think that there's a lot of people looking and running the numbers all the time on this, but it is a risk we're watching.
Yep, makes sense. All right, Adam, I'll give you the last 30 seconds. Any closing remarks before we close this thing out?
Well, I think that the biggest thing that I just want to remind everybody is we call these bear market brews, and bear implies negativity. The market's going down. we do want to rename these webinars to bear or bull market brews. We've talked in the past about things you can do during a bear market. One thing I want to remind you is that the best is still ahead. There's so many good things. Just think of all of the people working on a vaccine, working on improving healthcare. Let's think about all the benefits that's going to come out of this. I think we're going to have some changes to our healthcare system for the better. I think it's also going to change our business practices to be more efficient. I think, the other thing you want to remember is that some of the best businesses ever created were created during recessions and created during bear markets. So entrepreneurs get creative during these times and they think about where's the biggest need. And so I'm excited to see where we are in 1, 5, and 10 years because of this event. This is obviously an event we'll never forget, but we have to remember that the best is ahead. It's hard to have that long range thinking when we're all living kind of day to day. But I just want to thank everybody for joining us. We're so excited that you're here joining us for these events, and we appreciate your questions. If we didn't get to your question, please email us at bmb@hzcapital.com, and we would love to follow up with you.
Indeed, we would. Thank you again for your time. We will get through this together. Join us each week for our virtual happy hour. Tell a friend. Remember, 1,000 subscribers, Austin will sing Bear Market Blues. Also, drop us a note. Do you think I should cut my hair before the bear market is over? Or do you think I should let it grow out? On behalf of Adam, Austin, I am Tony Hixon, sending you virtual cheers. Remember, the best is ahead. See you next week. Can't wait.
Cheers.
Cheers.